In 1913, Britain stood as the world's economic titan, its empire sprawling across a quarter of the globe, with London fueling 50% of global capital investment. The pound was king, and the UK's industrial might defied its modest size. Yet, over the past century, this powerhouse has crumbled. The pound's value has eroded, and Britain's global influence has waned. While some decline was inevitable as empires fell and rivals rose, recent decades reveal a tale of self-inflicted wounds, misguided policies, economic blunders, and missed opportunities. From Churchill's disastrous gold standard return in 1925 to the austerity of the 2010s and the seismic shock of Brexit, the UK has grappled with stagnation, low wage growth, and a productivity crisis. Once the pioneer of railways and industry, Britain lagged in modernization, clung to outdated systems, and squandered North Sea oil wealth. Today, it faces a housing crisis, soaring inequality, and a GDP per capita stuck in neutral. How did a nation that once led the world fall so far? This is the story of Britain's economic decline, a century of hubris, missteps, and the high cost of clinging to past glories. Story: in 1913, Britain was the undisputed economic colossus. Its empire covered 25% of the world's land, and London was the epicenter of global finance, channeling half of all capital investment. The Industrial Revolution had made Britain the workshop of the world, its railways and factories setting the pace for modernity. Yet, over the next century, this titan would falter, its decline a mix of inevitable shifts and self-inflicted blunders that left the UK struggling with economic stagnation, a devalued pound, and diminished global clout. The First World War, 1914 to 1918, marked the first major blow. Global trade, the lifeblood of Britain's economy, contracted sharply, and national debt soared to fund the war effort. By 1918, the UK's economic supremacy was shaken, but the post-war years deepened the malaise. British firms, once pioneers, had grown complacent. Unlike their dynamic American counterparts, they lagged in innovation and productivity. The UK's elite, steeped in classical education at public schools, prioritized Latin over engineering, viewing manufacturing as beneath them. This cultural disconnect left Britain short of skilled workers and entrepreneurial zeal, allowing competitors like the United States to surge ahead. In 1925, Winston Churchill, then Chancellor of the Exchequer, made a fateful decision. Pressured by the Bank of England, he returned Britain to the gold standard at the pre-war exchange rate of £1 to $4.86. The move aimed to restore Britain's pre-war financial prestige, but the pound was grossly overvalued. Economist John Maynard Keynes warned it would cripple exports and growth, yet his pleas were ignored. The overvalued pound triggered deflation, stifled economic growth, and drove unemployment to punishing levels. Britain slid into a depression even before the Wall Street crash of 1929. The 1930s brought further misery. Treasury economists, clinging to classical orthodoxy, responded to the Great Depression with austerity, slashing unemployment benefits and raising taxes to balance the budget. Keynes again opposed this, arguing for stimulus to boost demand, but the government doubled down. High unemployment and sluggish growth defined the decade, cementing Britain's economic woes. The Second World War, 1939 to 1945, delivered another devastating blow. The UK emerged victorious but financially crippled, losing nearly a fifth of its wealth. National debt skyrocketed, and the country required a massive loan from the United States to stay afloat. Unlike France, Germany, and Italy, which used post-war Marshall Plan funds to modernize industry, Britain squandered much of its resources maintaining the facade of a global power. By the 1960s, Britain's infrastructure was outdated. Its railways still relied on steam and mechanical signals, a relic of the 19th century in a world racing toward modernity. The UK's class system and lack of vocational training further hampered progress. British Leyland cars became synonymous with shoddy quality, a stark contrast to the efficient industries of Japan and Germany. The end of the empire compounded these challenges. Britain had once enjoyed captive markets and monopolized raw materials, particularly from India. But decolonization and the US-led Bretton Woods system shifted trade dynamics, reducing Commonwealth trade and exposing Britain to fiercer global competition. Initially, the UK resisted joining the European Economic Community, EEC, a decision it later regretted. Vetoed twice by French President Charles de Gaulle, Britain finally joined in 1973, but by then, its European rivals had a head start. The 1970s were turbulent. Soaring oil prices fueled inflation, sparking industrial strife as unions struck for higher wages. By 1976, Britain faced the humiliation of seeking a bailout from the International Monetary Fund due to a balance of payments crisis, a low point for a once mighty economy. The discovery of North Sea oil offered hope, but its benefits were fleeting. When Margaret Thatcher won the 1979 election, she introduced radical changes. Her monetarist policies aimed to tame inflation but triggered a deep recession. Unemployment soared, and manufacturing, already weakened, collapsed further. The 1980s saw a shift to a service-based economy, with London's financial sector booming after the 1986 Big Bang deregulation. However, this prosperity was uneven, creating a two-speed economy, a thriving southeast and a struggling north, a divide that persists today. North Sea oil, a potential game-changer, was mismanaged. Its revenues propped up the pound, hurting exports and manufacturing, a phenomenon known as Dutch disease. Unlike Norway, which invested its oil wealth in a $1.3 trillion sovereign wealth fund, Britain used the windfall for tax cuts, particularly for high earners, reflecting Thatcher's privatization ideology. Major industries and even council houses were sold off, exacerbating a housing crisis that would later spiral. Thatcher's support for the EU's single market boosted trade, but the decade ended with inflation creeping up and an economic bubble bursting. The UK's membership in the exchange rate mechanism, ERM, kept the pound overvalued, echoing the gold standard debacle. On Black Wednesday, in 1992, Britain was forced to exit the ERM, devaluing the pound, but sparking a recovery and the longest period of economic expansion on record. By 1997, New Labour inherited a robust economy with low inflation and debt. Under Tony Blair, public spending on education and healthcare rose, and the narrative of no more boom and bust took hold. But beneath the surface, trouble brewed. Deregulated financial markets fueled a massive asset bubble, with complex derivatives inflating housing and stock prices. When the 2008 financial crisis hit, Britain's reliance on financial services made it uniquely vulnerable. The pound devalued by 30%, tax revenues plummeted, and the budget deficit soared. The crisis exposed the fragility of Britain's economic model. In 2010, David Cameron and George Osborne's coalition government seized on the crisis to push austerity, slashing public spending and investment despite historically low interest rates that made borrowing cheap. Keynes, who had long advocated against such measures, would have despaired. Austerity stifled recovery, eroded public services, and deepened inequality. Productivity growth, already weak, collapsed further. Ambitious projects like HS2, meant to modernize infrastructure, were mismanaged and eventually scaled back, a far cry from the Britain of Isambard Kingdom Brunel. Immigration, a long-standing feature of British society, became a flashpoint in the 2010s. Post-2004 EU expansion brought millions from Eastern Europe, and net migration hit record highs. Amid stagnant wages and austerity, public discontent grew, culminating in the 2016 Brexit referendum. The vote to leave the EU shocked the world, devaluing the pound by 13% and reintroducing trade barriers. Leaving the single market and customs union reversed decades of integration, with economic models estimating a 4 to 5% GDP loss, a blow Britain could ill afford. The housing crisis worsened, with rents and prices outpacing incomes, driving homelessness to record levels. Since 2008, GDP growth has relied heavily on population growth from immigration, masking stagnant GDP per capita. The UK's investment levels, the lowest in the OECD, and dismal productivity growth underscore its economic malaise. The past century reveals a pattern of missed opportunities and policy missteps. Churchill's gold standard blunder, the failure to modernize post-war, the squandering of North Sea oil, and the embrace of austerity in 2010 echo the same treasury orthodoxy Keynes decried. Brexit, driven by political rather than economic logic, compounded the decline. Britain's class system, aversion to vocational training, and over-reliance on London's financial sector have left it ill-equipped for the modern world. Once the pioneer of industry, Britain now lags in infrastructure and innovation. Its railways a symbol of a nation stuck in the past. Today, the UK faces stark challenges. Its GDP per capita lags behind the US and much of Europe, and inequality remains entrenched. The housing crisis, low productivity, and post-Brexit trade frictions continue to erode living standards. Yet, Britain's history suggests resilience. The post-1992 recovery showed its capacity to rebound, and London remains a global financial hub. To reverse its decline, the UK must invest in infrastructure, education, and innovation, breaking free from the cycle of short-termism and nostalgia for the empire. The story of Britain's fall is a cautionary tale, but it need not be the final chapter. With bold reforms and a rejection of past orthodoxies, the UK could yet reclaim a brighter economic future.